welcome to the 43 lecture, Barcelona School of Economics lecture. As you know, we can do this thanks to Banc Sabadell, who has been sponsoring the Barcelona School of Economics since its foundation. It's a member of the board and actually is a member of also the economic committee, and they really follow us and give us support in our activities, in research here with the lectures, and also in the academic programs. So actually, usually we have one representative from Banc Sabadell with the introduction of this lecture, usually Sofia Rodriguez, but unfortunately she could not come today. She had another commitment that she couldn't rearrange. So I'm just playing the role of thanking the sponsors as BSE, and hope to have this firm and bank supporting us for years to come, so we can keep doing these lectures. Okay, so it's a great pleasure, of course, for us to have John Moore from University of Edinburgh, and the room is full, so it's clear that he is a great, attractive speaker. We had also the opportunity to listen to him in a seminar. Now I'm not going to get into more details because we have Andrea Cagese, who is actually going to introduce John. Okay, so thank you very much. And I'm going to keep...
Very good. So good evening. So let me say I'm extremely happy and honored to introduce the lecture by Professor John Moore today, and he probably doesn't need introductions, but let me say that I think his research is quite unique in that it includes groundbreaking contributions in both micro and macroeconomics. And I think the importance of the work by John is underscored by the fact that his papers are essential building blocks for researchers that work in very different fields, such as economic theorists or researchers in finance and macroeconomists that study the interactions between real and financial variables and their aggregate implications. So in the field of economic theory, John's research has been key in helping define the nature of the firm, and especially in developing the foundation of the theory of incomplete markets. These contributions have had wide applications in several contexts, such as finance, international trade, industrial organizations, and many other fields. In finance, the idea that financial contracts are incomplete is essential to understand the firm financial frictions and the role of collateral. In the groundbreaking paper on credit cycles, with his co-author Nobu Kiyotaki, John formalized more than 25 years ago many elements that I think are at the core of macrofinance models today, such as, for example, the presence of misallocation of resources across heterogeneous agents, and the feedback effects between financial frictions in individual decisions at the firm level and the aggregate output and asset price. Now, the central message of the paper, of the credit cycle paper, was that relatively small shocks can generate large business cycle fluctuations if credit markets are imperfect. And such a message has been, I would say, spectacularly validated with the 2007-2009 financial crisis and Great Recession. One common element, I think, of John's past as well as recent work is that his paper always tackled important and very broad economic questions with very fresh and original approaches. So, for example, one key economic trend in recent years is the rise of intangible technologies and knowledge capital. Now, this also implies the rise, of course, of inalienable human capital, which is a key knowledge input in the firm. And now these issues are central of recent work by John and his co-authors, and I believe also is central in today's presentation. So I could and maybe should spend more time emphasizing John's key achievements. For example, he has been awarded many prestigious awards, such as the E.D.O. Johnson Award of the European Economic Association, then Stephen Ross Prize in Financial Economics, the Banque de France TSE Senior Prize in Monetary Economics and Finance, and the BBVA Foundation Frontiers of Knowledge Awards, among many others. But another thing I can say, after having attended John's lecture many years ago when I was a graduate student at LSE and many seminars afterwards, is that John is really a fantastic presenter. So I don't want to take more time, and so I am happy to leave the floor to him.
Thank you so much indeed for those very kind words. So this is joint work with Nobu Kiyotaki and Shenxing Zhang from the LSE, and reporting on 3 papers. The third, which is none of it's been written, I'm afraid, is also joint with Gabor Pinter from the Bank of England. I was asked when coming to give this lecture to make it broad, and to that end I felt the need to do some empirical work. Gabor has been doing the heavy lifting on that, so I must give all credit there to him. This is the first time I've ever stood up in public and presented empirical work, so I'm extremely nervous. I even bought a new pair of shoes for the occasion. So some of this, incidentally, some of the ideas I covered yesterday in the talk at Cray, so forgive me for those of you who were there that it's going to feel repetitious. When a firm borrows or raises funds to finance new projects, I think it's not too controversial to claim that the funders, the deep pockets, take a relatively short horizon about the project. So although the project may be quite a long-lived thing, the funders only look at the near term. So, for example, on debt financing, there's a very important paper by Lian and Ma in the QJE last year, and one of their findings was that often debt is subject to covenants where they stipulate the firm can't borrow more than, say, 3 to 4.5 times the earnings before interest, tax, depreciation, and amortization. Now, I'm taking 3 to 4.5 as a relatively small number. So in that sense, if I can leap from that fact to the idea that creditors really don't look that much beyond, the first few years. And on equity financing, here I understand there's quite a controversy, but there's certainly one half of the controversy argue that investors in equity markets also have short-term horizons, and that it's the next, say, 5 years' worth of earnings which have a major role in dictating stock prices. So the questions are, why do financiers, either people who are buying debt or people who are buying equity, why are their horizons relatively short, even though the project may be long? And then how do these short credit horizons, or funding horizons, let me say, because I don't want to sort of make this a talk about debt in particular. In fact, the model will be a model of equity. Anyway, how do these short funding horizons interact with growth and business cycles? And the key approach is that key workers, in Britain, by the way, the word key worker post-COVID is referring to people who are keeping the society going during COVID. I don't want to use that version of the word key worker. I want, if I may, think of key workers as the original meaning of it, very important workers, chief scientists, people who know about what's going on in the finance, the CEO, etc. Key software engineers. We argue our starting point is that the human capital of key workers is essential to not only starting a project, but also maintaining it. And that human capital is inalienable. So people have difficulty promising to be well behaved ex post. Ex ante, at the time of raising money, I'm going to be the engineer / entrepreneur for the rest of the talk, and perhaps you could be the deep pocket funders. So I may promise you at the time that we're making the investment, so today is, let's say, Friday, we're making the project starting today, and you're lending me to pay for the inputs. I may say to you on Friday, look, I'm going to be a very good boy on Saturday and Sunday and Monday. I'll do what I promised to do. Now, you can't take that promise at face value. So my human capital is something which you can't purchase. It's inalienable. And that goes back to a paper I wrote with Hart in 1994. So the model. So it's a discrete time, infinite horizon. At date naught, which is today, let's say Friday, the construction of the project requires a group of us, Johns, if you could bear the thought, imagine N of me, who are the key workers, where N is possibly one, but the interesting case is when it's two or more, it'll turn out to be. So we put what we have by way of net worth into the project, but we need more money to pay for the inputs as a whole. And the technology is that here on Friday, today on Friday, we have this Leontief inputs, fixed proportion inputs of per unit of plant that we're going to be making. We have X goods going in per building, if I may call it that. So the plant is going to be sitting inside a building from tomorrow onwards, Saturday onwards. And we'll normalize the initial productivity of the plant to be 1. So Z is going to be denoting the productivity, ZT will denote the productivity of the plant at any given date, T, and Saturday tomorrow is date 1. And today is the ex-ante date, 0. Buildings are perfectly elastically supplied, so the price of a building, Q, is the discounted value, well, it's discounted using the gross interest rate, capital R, greater than 1, of the flow of returns of building services, F. We think of parking lots. So, if the building isn't being put to use housing a plant, then perhaps the space could be used for parking lots or for storage facilities or something. Anyway, whatever dictates RF, that's the rental price of buildings out in the marketplace, which is we take parametrically. I say we in the sense of me or my other Johns up here on the stage and you, the deep pockets, today at date naught on Friday. Now, the scale of investment is this critical ratio. There are N of us, N Johns, and we each put in our net worth on Friday. That goes to pay for the inputs, which are X goods plus Q, the price of the building. This is constant returns, so X plus Q is the gross unit investment cost. But I'm also raising per unit an amount B from U, and let's call that, B is highly endogenous, and let's simply give it the letter B. So B is the external funding capacity per unit. And given constant returns, we just take what net worth Johns can collect, all of N of us can collectively put in, that's the numerator, and divide it by the, if you like, required down payment per unit of investments, which is the gross cost, X plus Q, minus the leverage, B, per unit. Now, there's a simple trade-off, ex ante versus ex post. I would, of course, like to pay you as little tomorrow as possible, and to that end, B would be low. But if B is low, then I won't be able to invest. The scale of investment, this ratio, would be low. And I don't want that. And in the race between the two, I prefer big today, even at the expense of having promised you more tomorrow. So if I could promise the earth tomorrow, that would push B up, raise the scale of the investment today, and that would be good news for me. So have in mind that this project has intrinsically a return which is superior to R, which is why I want to, other things being equal, raise the scale and push up the scale of the operation as much as possible. Now, given all that I just said, the way to raise B as much as possible is to sell as much of this project as I can to you. Now, I can't sell me, I should say we actually, because there's several of us, N of us. We can't sell you our human capital, but we can sell you the plant. So we do. So B is actually simply the price of the plant. And you're from Saturday morning onwards, you're the equity holders. You're the controlling interest in the physical plant. Now, at any date from tomorrow, Saturday, date T is equal to 1, onwards, let's suppose the productivity ZT is equal to some level Z. and Z has got a natural ceiling of 1. And remember, I'm assuming that the new plant is at its max level, 1. And what productivity means is that on that morning of the day in question, you will get AZ goods. And those goods are automatically yours because you're the owner of the plant. So there's no moral hazard associated with producing the output from the plant day by day. And you, being the owner, get it. So A times Z is the number of goods on this particular day that I have in mind that you get. No need for my skills. But where my skills kick in is in a sort of roundabout way that my skills are useful, our skills, I should say, there are N of us, I keep saying that. Our skills are useful because they are crucial to maintaining productivity. So ZT plus 1, the level ZT plus 1, will be a function of how well behaved we, the Johns, are the Little Johns. I don't know whether you know Robin Hood, but he had a big friend called Little John, so we think of ourselves as the N Little Johns. It depends on how well behaved the Little Johns are. Now, if all N of us, we call ourselves engineers, if all N of us work, then ZT plus 1 is given by, Z prime, which is a weighted average of the current Z and 1. So if the current Z is the current Z is less than or equal to 1. So if the current Z is less than 1, then God is good to us, or to you, I should say, and slowly but surely the productivity rises back up to 1 through that AR1 process. Let's call that amount Z prime. Now, if only N minus 1 of the Little Johns pull their weight, and remember, whether I pull my weight as a Little John is at my discretion, because that's the inalienability of my human capital. If only N minus 1 of the Little Johns work, as I call it, and the other one, the nth, shirks, then tomorrow's productivity is a scaled down version of Z prime, where this square bracket is, look at it, 1 minus theta over N. If you could just live with that particular functional form. That square bracket is less than 1, and it will mean, therefore, that Z hat, which is tomorrow's productivity in this event, will be lower than Z prime, naturally, because one of us shirked. And then I'd like to go dramatically and say that if less than or equal to N minus 2 of us work, and then there's 2 or more of us shirk, then the whole project falls apart. So each of the Little Johns has you, to an extent, by the neck. Because without our human capital, the quality or the productivity of this project that you own will fall. On the other hand, there's a sort of element of competition among us, and we're going to be looking at a Nash equilibrium in the little game that's going to be played every day between us and you. Now, this is a roundabout technology in the sense that our human capital is there to sustain productivity. But once we arrive at date t plus 1, and zt plus 1 is whatever it is, you get a times zt plus 1 out tomorrow. So I'm just repeating what I said a few minutes ago, that the actual output production is automatic. It's the maintenance of the productivity that generates that output, which is not automatic. And I think of this as an Austrian technology, and Bohm-Bawerk, the leader of the Austrian school in the late 19th, early 20th century, wrote about such matters. Now, the amount that we get paid is going to be a matter of negotiation. So this is going to be a bargaining model, and I'd like to call W the payment that each of us gets per period. Now, these diagrams, I hope, will help repeat what I just said to you, which is that if all of us work, then Z gravitates back up towards 1 in this sort of God is good to us sense of AR1 process. If, on the other hand, one of us shirks, then you end up with a productivity Z hat, which is obviously lower than Z prime by the factor, that square bracket. The gap between Z prime and Z hat is, in effect, a little John's marginal contribution to maintenance, is it not? So just looking at the algebra, forgive me, it's not a good lecturing technique to ask you to go through algebra. I will do a little bit of algebra. So just going through the algebra, Z prime minus Z hat will be the 1 minus theta over n times Z prime. But then substituting the Z prime by this AR1, we get the formula for the gap, which is my marginal productivity. There's a place called Z lower bar, below which Z never goes, if you think about the algebra that I've just shown you. So if only n minus 1, if we were starting at Z lower bar, and all of us work, then it'll creep back up towards 1, Z prime is higher. On the other hand, if n minus 1 of us work, you get stuck at Z lower bar, and Z lower bar is strictly above 0. So Z, t, at all times lives in the interval between Z lower bar and 1, whatever the history happens to have been. And then there's a natural upper bound where, because of the AR1 process, if we started at that upper bound and all of us worked, we would simply stay there, whereas if one of us shirked, we would drop back down again. So that was some diagrams to ram home the algebra that we did. Now, coming back to the Friday ex ante moment and the determination of little b, which is very important because it's sitting there in the denominator. If I may make the same joke that I made yesterday, but this paper is all about that denominator, x plus q minus b. Let's just go back to it. This formula here for the scale of investment in the denominator is x plus q minus b. This paper is all about the denominator, and I wanted to call the title of the paper The Denominator in honor of Arnold Schwarzenegger, but Nobu wouldn't let me. Now, everything Nobu and I have ever written has been about the numerator, so this is a paper about the denominator. And in there is b, and so we need to think hard about b, the determination of b. So up here, we've got the formula for b. It's how much you're willing to pay per unit on Friday at ex ante, date naught. Answer, well, it'll be your value of 1 unit of the plant, which starts off normalized productivity at 1, the max, discounted backwards from Saturday to Friday using the daily overnight gross rate of interest, capital R. Now, that's fine, but what is V, the function? So for V, we need to think hard. It's a Bellman equation. So start a generic value for capital V. So V is the measure, it's the discounted value of the plant to you, assuming that we're at some arbitrary date at which the current productivity is Z. Well, the deal is the first thing that happens is you get AZ in automatically. And then, let's say at lunchtime that day, you could liquidate if you wanted to. And so you could sell the building at its market resale value, which is Q. Or you could keep going with me or us, and then we're going to start bargaining. And let's say the wage that we agree on, finally, will be W of Z, more of that in a second. You have to pay it to N of us. And then tomorrow morning, you'll have, on the equilibrium path, productivity Z prime. That was the formula I showed you earlier, again, discounted back from tomorrow to today. So that's the Bellman equation, and the question now is, what is W? Now, this is before I tell you the mechanics of determining W, let me say this is a simultaneous system in two functions. It's not a total breeze, because we need to, in order to figure out what W is, we need to know what V is, but in order to know what V is, we need to know what W is. So we have to look for a full fixed point of these two functions. Now, the particularities of the bargaining is as follows. That I'm going to suppose that each engineer, each little John, makes a take-it-or-leave-it offer to you, taking the other engineers as offers as given. So this is a Nash equilibrium among the n Johns, making n respective take-it-or-leave-it offers. And it means what it says. You don't have to say yes to anybody's offer. Now, in equilibrium, you will say yes to everybody's offer, as long as we're not too greedy. And the maximum amount of greed is I will push my demand, my offer to work, up to the point where I hit the marginal product, which is what I was talking about previously. So, given all that, and this is actually rather critical, assuming we're not at the part of the parameter space where you do want to liquidate. So I'm going to, let me just give the game away here. Z lower bar, which remember is the bottom end of the Z distribution, possible Z distribution, is sufficiently high relative to Q. I mean, roughly speaking, it's sufficiently high relative to Q that you don't want to liquidate. So when I say away from liquidation here, and suppress reference to this max Q operator. So look here, I've got the same functional form, the same Bellman equation, but stripped of the max Q. That's permissible. It's all a sort of bootstraps argument. That's permissible given what I just said. Anyhow, the W of Z, which I will demand, will be the gap between V of Z prime and V of Z hat. So the productivity gap was Z prime minus Z hat. That was what I showed you on the earlier diagrams. But in dollar terms, the amount that I can squeeze out of you is going to be V of Z prime minus V of Z hat. And remember, the V itself is simultaneously determined with the W's. That's the sense in which we have to look for a sort of overall overarching fixed point. So that's given the nature of the bargaining, this Nash equilibrium, W of Z will be determined by that. Now, a proposition, we had quite a lot of difficulty trying to prove uniqueness. And the best we could come up with was this. Assuming we're away from liquidation, within the class of polynomials, V of Z is unique, and it's affine. So these are undetermined coefficients right now, but so your value of Z, this is the bit of algebra which I'd like to bore you with, if I may, take you through. But it turns out that your value function, as a function of the morning's productivity Z, is going to be a linear function of an affine function of Z. Just for the record, I have constructed discontinuous. I know that unique. I know it's not unique. Okay, so it's only within the class of polynomials that this proposition holds. Anyhow, enough of that. So WZ is borrowed from the previous slide, just simply the gap between these V's discounted, and that, given the slope, given this linearity, so little nu here is the slope of the V function, that would just be nu over R times the gap in the Z's, and the gap in the Z's from what we were looking at earlier, is 1 minus theta over n times Z prime. And the Bellman equations, well, we start off with it, minus the stripped of the max Q operator, substituting in this W in here, so I've just replaced n times minus n times W of Z by minus n times this top right-hand side. Nothing else has changed, except I've substituted for Z prime. I've substituted for V using my proposition up here, so it's C plus V nu times Z prime. Putting it all together, we've got a formula for V. Of course, it's not that good yet because I don't know the coefficients yet. I don't know what C is, I don't know what nu is. Now, if we do it, also substitute into the left-hand side the functional form that the proposition tells us, and substitute in for z prime using this AR1 process into that right-hand side, putting it all that together, you end up with this identity which has to hold for all values of z in the critical range from z lower bar up to 1. So here we're back on home turf for macro theory. As a guess and verify, we can just equate the constant terms left-hand, right-hand sides, equate the slopes of z left and right-hand side, and out of that will emerge these unknown coefficients, z and nu. And nu turns out to be this rather, I hope, intriguing, doubly discounted sum. So the slope, remember what nu is, it's your slope on your value function of productivity. So the marginal value of a unit of productivity, this nu, is apparently given by a discounted sum of the a's. Now, superficially, you'd think, well, it's pretty obvious what nu is. It's just a plus a over r plus a over r squared plus a over r cubed, isn't it? I mean, one more unit of productivity. Remember, the technology spews out a times z every day, so isn't it obvious, just a plus a over r plus a over? No, it turns out that this is being bitten into by these theta rows on the top line. And what's more, it's being progressively more bitten into the further into the future we look. Theta and rho is the parameter from the AR1 process. Theta was the 1 minus theta over n parameter for the loss between z prime and z hat. They're both algebra, they're both Greek letters between 0 and 1. So these numerators here are doubly depreciating the summation. Now what's going on, if I could just turn to intuition, is that every day, each of the little Johns is biting into the cherry. I mean, again, forgive me, I used this parallel yesterday lunchtime, but each of the little John bites into the cherry, but the cherry is a long-lived cherry because I'm contributing to the productivity today, but the productivity today perfumes tomorrow's productivity, which perfumes the day after tomorrow's productivity. So when I come to you and demand a wage, and you have to say yes or no to it, what you are looking at is the marginal productivity of my labor, bearing in mind that the impact of my marginal productivity is a long-lived affair. So when on Saturday morning, let's say start at t is equal to 1, when I say to you, I want this much, what I'm asking for is a remuneration for my contribution to Saturday, Sunday, Monday, Tuesday's outputs, etc. Now, on Sunday, I do the same again. I come to you and say, right, I want a wage reflecting my marginal product, and my marginal product on Sunday is the impact on Monday, Tuesday, Wednesday, Thursday, and so on. So by the time we reach, I don't know, next Tuesday, there have been 3 days of me biting on that Tuesday cherry. On Saturday, I bit into the Tuesday cherry. On Sunday, I bit into the Tuesday cherry. On Monday, I bit into it. And so what's left of the Tuesday cherry for you is dropping like a stone. So if we'd not been talking about Tuesday's cherry, but we'd been talking about, I don't know, next Thursday's cherry, then there would have been 5 days of interim days worth of me biting into it. Of course, if I could commit on Friday today not to do any of this nonsense, I would, because that would enable me to have so much bigger plant. But I can't because my human capital is inalienable. So every day further into the future you look, on Friday when you're thinking about investing in this project, you think, I'm going to get less and less of this cherry. We've got this analogy of buying a fancy car, let's say a Tesla. You buy a car and you own a Tesla and you think, great, I've got this Tesla and hopefully it's going to last a long time. By the time 10 years, if you look 10 years into the future, you've had to pay the Tesla garage mechanics and what have you, software engineers for the updates and all that jazz 9 times. And actually, more of the car belongs to Tesla in year 10 than it belongs to you. Of course, by the time you reach period 10, you're still the proud owner of a Tesla that you hope is working well, and you can feel pleased that you're the owner, but actually you've paid for it a lot along the way. So to own something after a chunk of time has elapsed doesn't mean to say that ex ante you own it. Far from it. In this case, it's the little Johns that, in effect, own most of the later period's worth of return. Bottom line, then, is your horizon for investment when you're on Friday, ex ante, date naught, thinking about how much little b to pay per unit of investment, you take a pretty dim view of the later periods. So that squares off with my sort of anecdotal evidence about short-termism. Now, luckily, we don't need to go into this. The wage, or rather the wage bill, because there are N of us, is a forward-looking object. I've said that in words about, every day I come to you asking for my marginal product, but my marginal product is a long-lived object. And therefore, R appears in the formula for wage. These are not blue-collar wages. These are sort of senior executive wages, remuneration schemes. They could be stock options, but every day I come and ask for another stock option from you. Jumping ahead, if R were to fall, so if we move to a low interest rate regime, this would go up. So that would be a prediction of the model. We don't have data on, senior level executive compensation, but we do have data on connected things, which I want to show you later. And then, thanks to this, B, on the face of it, B is terribly boring. It's just 1 over R times A minus NW, that's Saturday, plus 1 over R squared times A minus NW, same thing, Sunday, etc. So the bracket here, A minus NW, is the same old thing every day. So looked at like that, it's a terribly flat return that you're looking forward to. But if we substitute for W or NW using the formula up there, we find that a more revealing way to express B is, as it were, the cherries, starting with Saturday. Well, the Saturday cherry A is entirely yours, so that's A over R. The Sunday cherry A has been bitten into once by me on Saturday. The Monday, and then discounted by R squared. The Monday cherry has been bitten onto me twice. Now the blue refers to the Sunday bite, and the red refers to the Saturday bite. The Monday cherry has been bitten into by me on, did I say Monday? Now Tuesday. The Tuesday cherry is bitten into 3 times, once on Monday, which is purple, once on Sunday, which is blue, and once on Saturday, which is red. So the square bracket that each of these A's is being multiplied by is dropping. So geometrically, that is what I've drawn here as the green line. So as a function of time, the gross return here per period is flat at A, per unit of productivity. But the bit below the green line, which is your share, isn't, of course, 100% because you're paying me these wages. But when you do the calibrate, or if we write down the formula for B in the way that I just did, which I hope is the most revealing, we generate this this green line, which is just the geometry of the algebra of the intuition, which is the longer into the future we look, the less of it is genuinely yours. Meantime, back at the ranch, there's this flat black line here, which is just A minus NW. And that, I said earlier, is that's the first thing you write down when you want to write down what B is. It's just, the discounted value of A minus NW. So in this diagram, using R as your discount factor, the area under the green line is the same as the area under the black line. But the green line is the more interesting one. Now, the opportunity cost of this building per period is F. So a question you perhaps ought to ask is, what happens when the green line crosses F? Shouldn't you at that point, liquidate? Because your return, which is what's below the green line, seems to be below the opportunity cost. And the answer is, it took us some time for this penny to drop. The answer is no, because if you look forward into any time in the future, tau, life has started again. There's a new green line, starting with that current z is equal to 1 on the equilibrium path it will be. And the shaded area are wages that you've paid me in the period between naught and tau. So yes, the original green line may eventually cut the F line, and you might think, well, I ought to liquidate at that point. But actually, since these are all sunk costs to you, wages, you carry on. It's a bit like this Tesla. The Tesla won't be yours in 10 years' time. Surely then you should sell it. Answer, no, because all those 9 years' worth of maintenance costs you paid the garage are sunk, and it's still worth your interest carrying on owning the Tesla. I hope I'm not sort of flogging a dead horse here, but that's right at the heart of the whole talk. Now, theta, we've done 2 sets of empirical analysis. One was with Yurin Ma herself, who was a co-author on that 2021 QJE paper. And she kindly she heard about this and kindly offered to do the following for us, which is to look back in her data set and find out how does the critical ratio, remember I mentioned a ratio of something between 3 and 4.5, which is the maximum indebtedness that firms are allowed under the covenants, divided by a beta. How does that ratio change as the firm becomes, I'd like to introduce the technical word, funky. So a funky firm is a firm with a lot of little johns, which is vulnerable to attack from key workers. So the more little johns there are, the funkier it is. Now, it's difficult to measure the number of little johns, but there are other things you might think of for funkiness. For example, the fraction of the capital which is embodied R&D, accumulated R&D, which is what's on the horizontal axis here. And the further to the right we are in this diagram, the more funky it is, or to put it another way, the more vulnerable the owner is to having the cherry being bitten into, and therefore one might imagine the tighter will be the borrowing constraint. And yes, indeed, it is the case that the 3 to 4.5%, 3.5, 4.5 multiple goes towards 3 as you become more funky. The long-run implications of this, and I talked about this yesterday, these are more macro, so I'd like to be brisk, if I could, at this point. The long-run implications of this is that when you look at aggregate investment, gross investment, which is born of the same ratio, the famous denominator here, which is x plus q minus b, are both, well, I'm interested in the thought experiment as to what would happen if we entered in a low interest rate regime, which has happened. We may be going in the opposite direction now, but over the last 20, 30, 40 years, even in Japan, there's been very low interest rates. What is the implication of low interest rates? On the face of it, low interest rates are good for borrowers and should be good for investment. But there are some offsetting effects. Q, the price of buildings, goes up when interest rates permanently fall. B, my ability to borrow per unit goes up when interest rates fall. I mean, that's the usual everyday sense that low interest rates are good for borrowers. But the question is the race between Q and B, is it won by Q or B? Now, Q is a long-lived, it's F over R minus 1. Whereas B, I don't know whether I wrote down the formula, but B, I didn't write down the geometric summation. B is something over R minus something less than 1. So could you just be algebraic for a second? A small drop in R has a big impact on Q, because it's F over R minus 1, whereas the same small drop in R has a much smaller impact on B. Why? Because your funding horizons are short. So this is me teasing out a macro implication, doing a comparative statics with respect to R. So it could be that in this race, Q goes up more than B. Now, there are other good things about low interest rates. The numerator could also go up in response to lower interest rates. So there are two good things about low interest rates, but one rather bad thing, which is Q. And overall, it's ambiguous, but the whole ratio can go down. So peculiarly, low interest rates might lead to a suppression of investment and sluggishness of growth. And of course, low long-term interest rates sounds like quantitative easing. So playing games with the yield curve and pushing down long-run interest rates may have deleterious effects. Now, there are people in the room who've also written a very important paper about this same effect. Okay, let me just put that geometrically. When you look at the area under the graph net of Q, which is really what matters when you're looking at the denominator, you're really looking at this positive gray area minus this red area. Now, if interest rates fall, long-run interest rates fall, the value of this negative red area goes up a lot and can squeeze the summation. So that's the geometry of the idea that the denominator can go up. The denominator can go up when interest rates fall. And the denominator going up, of course, is bad news for investment. Proposition, for n greater than or equal to 2, a persistent fall in interest rates can cause Q to rise more than B, so that net funding capacity B minus Q falls. And an example of this is the housing market. When young people start trying to get on the housing ladder, if you ask them, do you want to live in a world with lower interest rates? The first answer they give is yes, please, because building societies, banks will be willing to lend me more. But then on further reflection, they might answer, actually, no, I'd prefer interest rates to be higher because the price of houses has gone up disproportionately more than the ability to borrow. So that's Q minus B going up. So it's great news for old people who've got a house, of course, but it's bad news for newcomers. These borrowed from the macro talk yesterday, but these are a macro model, details quite different from what I've described to you today, but just to give a sense of it, imagine there was a sort of unexpected drop in the interest rate from 2.5% to 1.5% at period 5. The initial effect on the economy is all good because the numerator dominates the proceedings. So net worth goes up. People who are short of money, like me, shallow pockets, are able to invest more. Investment goes up. Everyone's consumption goes up. Output goes up. It's all good news. This was Japan in the late 80s when, the value of the imperial palace was greater than the value of California. So property prices were through the roof and people were feeling extremely wealthy. But that was the beginning of a long, slow decline. Another example is not, and I don't feel comfortable saying this here, but might it also be true of Spain at the entry to the euro when real interest rates were permanently lowered, there was initially a boom in property and everything felt good. But because of the effect that I've tried to identify now, the effect on the denominator, the long-run impact on the economy can be bad. And so, although looking at investment here, the long-run growth path of the economy, again, I must emphasize this is a quite different model, it's a growth model. The long-run growth path of the economy could be lowered permanently as a result of the permanently lower interest rate, and ditto consumption and output. Now, of course, I don't want to overdo things here. Low interest rates surely are good for the economy, I think. And the answer is yes, provided the cyclicality or the length of the lowness, the drop in interest rate is relatively short-lived. So they're terribly artificially. Imagine that the real interest rate was following this dotted black sine wave. Then, because this is a relatively short period of low interest rates, the usual idea kicks in that borrowing capacity goes up, but the price of buildings, which are very long-lived, doesn't go up as much because buildings take, as it were, the long view, whereas the investors, the people putting into my project on Friday, take a shorter view. So in this case, with this relatively short-lived, or let's say business cycle length drop in interest rates, the lowering of the interest rate is good news for the economy. But if we extended the cycle so it was, huge, some enormous sine wave like this, now the disease is picked up by the property price, the building price, and so the extent to which the building price goes up is greater than the extent that B goes up, and that suppresses, and the bottom of these diagrams is investment and output. So if short-term interest rate policy, or medium-term interest rate policy is followed, that's good news. It's the standard pro-cyclical. But if we go for longer term, our point of view would be you might be in danger. And I think that's what certainly nobody feels about the Japanese economy. Just before I move on to my data analysis, could I just mention there is a possible policy prescription here, which is where the government should tax payroll earnings. Your payroll would be taxed, and that money could be used simultaneously to subsidize new investment. Okay, so this is the bit of the talk where for which I bought my new shoes. Are we okay for time? So can I have a go at doing this? I hope it's going to work. Gabor Pintor at the Bank of England has access to a massive database because it's what's it called, administrative. Every firm in the UK, from small to huge, manufacturing, non-manufacturing services, you name it, has to submit annual accounts to Companies House. And the Bank of England holds a database of these things from, the bit of it we've looked at is from 97 to 2020. 6 million firms, so that's universal coverage. Now the data, among other things, is pretty good actually in supplying information about the number of directors. It's not quite so good about talking about the number of employees, the head count. It also provides information about directors' wages and the wage bill of the company. Now, I'm going to use that information as a rather cheap and cheerful proxy for funkiness. So funky in my world was a world where n was bigger, for example, or theta was smaller in my bargaining model. More of precise definition of funkiness in a minute. Oh, sorry, no, maybe I should do it right now. So what we do is split the firms into 10 size bins, equal-sized bins of firms, from the smallest to the largest, and we do that by number of employees. So that's a sort of standard method. We've also done it by size of the balance sheet, but let's stick with head count here. So the number of employees, we've got a small bin, size 1, etc. Within each bin, we look at the ratio of the number of directors to the number of employees. Now, forgive me if you find this revolting, but we wanted to argue that the number of directors is akin to the number of little Johns. So we're thinking of directors. Many directors are not owners, they're just on the board directors. Many directors are key workers, they're the key chief scientists and the software guys, and so on. So in the absence of anything better, we thought that would be an interesting possibility to say, well, funky, can I use the technical word funky? Funky firms are firms for which the ratio of the number of directors divided by the number of employees is above the median within the size bin. And the non-funky firm are the other 50%. So it's very dirty. The critical distinction between funky and non-funky is just the median. Now, what we were interested to know, can I just take you back in theory here? B, your willingness to buy plant is this discounted sum of cherries that are, as I've gone on and on about it, bitten into more progressively to the more in the future you look. Now, the biting process, which here is captured by theta, the lower theta is, the more biting is going on. And the lower theta are what I think of as the funky firms. So these are firms which are particularly above the median in terms of funkiness. They're particularly exposed to, as it were, moral hazard on the part of key workers. Okay? And the algebra is saying to us that the more funky the firm is, the more short-term your horizon is, and the less long-run interest rates will impinge on your investment decision. So can I just repeat that? The more funky it is, that is, in the way we're measuring that is, the higher the ratio of the number of directors to the number of employees, the less interested you as an investor will be in long-run interest rates because you're not interested in the long run. Whereas for the non-funky firms, you're more interested in the long run. Okay, so there's a sort of possibly interesting differential with respect to movements in the long-run interest rate, or more precisely, the term spread, the gap between the long-run interest rate and the short-run interest rate. So to get progress, what we would like to do is to look at the impact of shocks to those two things, the short-run interest rate and particularly the term spread, and see whether a fall, a policy relaxation, a fall in interest rates would have more positive impact on the investment decisions of non-funky firms than funky firms. Let me just repeat that intuition. Funky firms, investors like you take a short-term view of them. So to be told that the long-run interest rate or the term spread has gone down is not that interesting to you. And therefore my ability to raise funds will be more limited. So even though in principle lower interest rates, lower long-term interest rates in this case are good news, it wouldn't be that much good news to me if I'm a funky firm. But if I'm a non-funky firm, I'll be that much more helped by a fall in the term spread. Okay, now to make progress, we want to bring into this mix something completely different, which is some measure of shocks to short-run interest rates and term spreads. So what we've done is to look at a 30-minute window around Monetary Policy Committee, this is all UK data, Monetary Policy Committee announcements of interest rate policy, and to see what happens to short rates and long rates and therefore term spreads across the 30-minute window. Now these meetings happen every month. Firms report their accounts every year, but they don't do it in sync. So, different firms report into Companies House on different months of the year. So for each firm, we accumulate the previous 12 months worth of interest rate shocks. And we hope these shocks are genuinely exogenous to the empirical investigation. Question: what is the impact of these let's think in terms of lowering interest rates, what's the positive impact this has on firms' investment decisions. So we want to run a regression where we have, well, in fact, maybe I just should show you. We want to run this regression. On the left-hand side, we have the investment growth rate over a 3-year horizon for the firm. So here we're now looking at fixed assets. Just for those of you who are into these things, the denominator, this is not a percentage because percentages are particularly volatile because of the problem of having zero on the bottom line. So we use what's called the Haltiwanger et al. Method of calculating growths of investment. So this is, on the left-hand side, is roughly speaking the percentage growth in investment of the fixed assets of this firm. Sorry, I put that too complicatedly. It's the percentage growth in fixed assets over a 1, 2, and 3-year horizon following an interest rate, what I hope is an exogenous interest rate shock. And then on the right-hand side, we have dummies. Well, the critical 2 lines are the first 2 lines. We have a dummy for being a non-funky firm times the short-run interest rate shock, and we're interested in the coefficient beta. H, by the way, refers to years after the shock, so we're doing this for 1, 2, and 3 years. And then we have an equivalent term for the funky firms, and again, it's a 0-1 indicator variable about whether you're funky or not, times the short-run interest rate shock. And then on the second line is the exact analogous thing, but let's call the coefficients gamma now, but it'll be the term spread. So we're interested in the impact of the cross term between the indicator function about whether you're funky or not and the shock to short-term interest rates. Now, I don't know about, here I'm just totally, I shouldn't say this, but I'm kind of totally amazed that we get anything because these are totally distinct bits of information. You know, the funkiness ratio is something pretty nerdy. It's the ratio of the number of directors divided by the number of employees. The interest rate shock is something, you know, ultra high-powered finance, you know, 30-minute windows across Monetary Policy Committee. And we're looking at the cross terms between those two things. So I have to say, I thought this couldn't possibly work. But it does. Okay. So summary statistics, I said that we first of all divide firms into size bins. So the smallest firms have total assets of £23,000. These are median values within the size bin. The median number of directors is 2, so those are often partners. And the number of employees might be 1. So on the median number of employees is 1. You know, they're 1 employee. Through to the opposite extreme, huge firms which have, you know, millions of assets, 12 million assets. And let's say on the median number of directors might be between 3 and 4. The number of employees is 24,000. Now the funkiness ratio, which is the first column divided by the second ratio, is falling like a stone, of course. Because in the small firms, basically it's just a mama and papa operation, and possibly one person helping them. And so the funkiness ratio is 2. Whereas for the big firms, the funkiness ratio is 0.01. So if we didn't do the size binning, we would automatically say, well, all the large firms are non-funky and all the small firms are funky, which would be, I think, to miss the point. So that's why we split them into size bins before we calculate the median funkiness factor. And then, and only then, we say, right, any small firm in bin number 1, which is above this median funkiness ratio, will deem to be funky. And any firm in that bin that's below it will be non-funky. Okay, so that's the determination of the capital Ds in my previous algebra. So this is the first regression I'd like to report. So the columns refer to year 1, year 2, and year 3. This is the growth rate, Haltiwanger style growth rate, between the shock to interest rates and, it's the growth in fixed assets between the year of the shock and the year after. That would be the first column. Between the year of the shock and 2 years later, which would be the second column, and the year of the shock to 3 years later, which is the third column. So we know that investment is reasonably sluggish, so we think, looking 3 years into the future seems necessary to the study. All right? So these are the 4 alphas and gammas with t statistics in brackets, and the right number, about asterisks, 1%, 5%, 10% significance. The thing I'd like to pick out is a comparison between the first 2 rows and a comparison between the third and the fourth row. Now, the first 2 rows, SR, is the short run interest rate. Formally, it's the 3-month interest rate shock. TS is the term spread over a 5-year interest rate shock. So that's the 5-year long rate minus the short rate. Shock to the 5-year minus a shock to the short rate. That's what we define the TS. Now, looking at the third column, I think the dust has settled by the time you reach year 3. So let's, if we may, focus on the right-hand column. Here on the right, the 16s are pretty similar. So that it looks to me that the funkiness factor doesn't impact the benefits of a lower short-term interest rate. These are positive numbers, which is reassuring. So a lowering of the short-term rate is good news for fixed asset growth. But these second 2 numbers, 28 and 17, are what I was hoping for, because the non-funky firms respond to the term spread more than the funky firms. So this is, I hope, evidence in favor of the proposition that funky firms, the investors, people like you, investing into firms that are funky, who've got lots of little johns, are less interested in the future, in the distant horizon, and therefore a change in the term spread will less impact on your willingness to lend to me, and that will have correspondingly less impact on my investment decisions and growth. Now, that's what we call the ridiculous regression. There are 82,000 firms that we're looking at here. The pruning down from 6 million is because we've pruned away firms that died, proved away utilities, we've taken away finance firms, insurance, quasi-government charities. Lots of things have disappeared by the wayside. And then on top of that, lots of firms didn't report the number of employees. Lots of firms, we couldn't get 3 years' worth of growth data together. So once you've done all that pruning, I'm afraid, we're down to 82,000. There's an interesting, dare I say, in America, a lot of research is done on CompuStat data, which is large listed companies. The smallest firm in CompuStat data would be in our bin size 10. So luckily, because of this UK data, which is really looking down at small and medium-sized firms, and all firms, we really are looking at perhaps focusing on a different part of the industrial structure. Okay, so 82,000 firms. This is a simple regression, a ridiculous regression. There were no controls. We could check for the statistical significance between 28 and 17, and it is. So the gap 11 has got 3 stars in it. Now, at the opposite extreme would be to put in a firm fixed effect. So we've got 82,000 firm fixed effects, which is, the opposite end econometrically from the previous regression. Now, the power of the model, the R-squared jumps up a lot, of course. But what we're interested to know is to see what happens to this gap again between, well, what was it before? It was 28 and 17, and it's now become 22 and 14. So again, this is statistically significant gap between funky and non-funky, whereas on the short interest rate, they're still the same. So apparently short-run impact, funkiness doesn't affect the impact of short-run rates, but it does affect the impact of long-run rates. You could run these regressions for each size bin and do a comparison across funky versus non-funky. It's not quite, the ranking isn't as clear as I would want, but it turns out that the heavy lifting is being done by the medium-sized firms. So there's something peculiar about the smallest firm. If you could do, I think this is kind of amusing, but with the smallest firm, you've got the problem of a fat median. Most small firms in our bin hit the median funkiness ratio exactly, because you're talking about 2 divided by 1 or something. And therefore we didn't know how to call them, were they funky or non-funky, so we decided to call them all non-funky. So the fraction of funky firms in the smallest bin is like 5%, but by construction the fraction of funky firms in each of the bins 2 to 10 is hitting 50% by construction. Now, we were worried that all of this was being driven by the small firms, but it turns out that the gap between the funky estimate and the non-funky estimate, remember we're looking for the non-funky being bigger than the funky, the action is happening in the middle-sized firms. So I think there's something odd about the small firms because we're not getting a good handle on funkiness. There's something about the big firm, the very big firms are probably not borrowing constraints. They're probably sitting on cash mountains or something, in which case my model is just not applicable. Looking at the total and then delving into which bins are doing the big contribution to the total, to my mind, it's a happy fact that it's the middling firms that are doing it. Okay, a couple more ways of thinking about, yes, 5 minutes max. The couple more ways of getting an angle on this is instead of looking at assets, look at liabilities. So we look at total debt. The number of firms that actually report their debt well is quite few, actually. So we're down to 24,000 now. So this is looking at the other side of the balance sheet, but we would like it to be the case that this notion that the long-run interest rate or the term spread doesn't affect investment should find echo on the liability side of the balance sheet, that the level of debt also shouldn't respond so much to a fall in the term spread. And so it's the same kind of diagram. We've got 3 columns. Look at the right-hand one, if you would. The 21's roughly equal to 21, very close, so funkiness doesn't affect the impact of the short-run interest rate on debt, but 20 is significantly bigger than 11. Funkiness does impact debt. So to put that into English, a drop in the term spread, long-run interest rates falling, which happens, by the way, more in zero lower bound episodes of time period, obviously, closer to 2020, that does impact debt. Now, last 1 minute, 2 minutes more, if I may. 5 minutes, okay, less. I'd like to try my luck with an alternative definition of funkiness. So I've been focusing on a head count ratio of number of directors divided by number of employees. Instead, what we've been doing here is to look at the ratio of the director's remuneration divided by the total employees' remuneration. So, what fraction of the total remuneration, wages, of a firm go to key workers? And the idea being that if that ratio is high, then it's a funky firm, insofar as a lot of the wage bill is finding itself in the pocket of a very few people, the key workers, the little johns. And then the logic being that those firms should find themselves less exposed or less benefiting from a fall in the term spread. All right, just for the record, the binning here is now done in dollars. Since we moved away from headcount on the funkiness ratio, we've also moved away on the measurement of a size. So we're using gross assets and putting them into 10 bin sizes from 1 to 10, before we then attribute funkiness up or down in the way that I was describing. And looking again at column 3, it's somewhat reassuring. It's maybe not quite so sharp, but the 32 is certainly distinctly bigger than 23, and it's statistically different and these two are roughly equal. That's what I think of as the ridiculous regression with no controls. The one with... By the way, the number of firms here is much bigger, 137,000, because firms are much better at reporting director remuneration, interestingly, and they're pretty good at reporting employee remuneration. They're less good at giving head counts. They're very good at giving the number of directors, but they're very poor at giving the number of workers, employees. But they seem to be rather good at giving, better anyway, at giving information on directors' remuneration and overall employees' remuneration. So the ratio for determining funkiness is more available to us. So we've got more firms, and well, maybe here the extent to which 21 is bigger than 17 is less impressive. But anyway, at least I'm reassured by two things. First of all these numbers are positive. And secondly, which is kind of good, so low interest rates are good news for investment and growth. That, incidentally, is an argument against what I was saying in the middle of my talk. So in the middle of my talk, I was making a song and dance about the idea that long-run interest rates might be bad for the economy as a whole, like in Japan. This is not happening here. All firms, it would appear anyway, are benefiting from low interest rates. But when it comes to which interest rate that we're talking about and which type of firm we're talking about, I hope it gives supportive evidence to our theory. Thank you very much indeed. Thank you.